Hello and welcome. Today I'm joined by John Bennett, who's the fund manager for the Henderson European Focus Trust. John, thank you very much for joining me today. Now, first things first, what can you share with us about any portfolio activity since the festive period?
I would say since the festive period, the only real change, if any, in the portfolio is the very deliberate further reduction in the number of stocks. The board of the trust fairly recently approved a new floor in the number of stocks, the new minimum, down from 50. So the previous range was 50 to 60 stocks, 60 maximum, 50 minimum. The new minimum is 45, and we are just about, once I finalise the sale of something today or tomorrow actually, one stock, we will be at 49. So a very deliberate, across all of the portfolios I run actually, a very deliberate further reduction, further concentration, further focus in the list of stocks, and the deliberate aspect of that is to give our clients, who are demanding this, to give our clients an even truer active and more stock-specific, more idiosyncratic stock-specific risk offering, because clients clearly increasingly go passive in developed markets. Europe's going that way, well and truly, as has the US. And therefore, as active managers, we have to be even more active, in my view, and indeed in most clients' views.
Now, Not Buying Europe was the title of a section in your recent AGM presentation, which at first glance definitely seems at odds with the Trust's European equity mandate. So what's the message here?
Yeah, I mean, the message of not buying Europe, it's actually something I've believed in since I started doing this, dearie me, 31 years ago. But I've kind of wanted to emphasise that you're not buying Europe when you buy our portfolio. And the reason I've wanted to emphasise it is it's quite tiring to hear, as often as we do, asset allocators or investors saying, well, I would buy Europe, but you see, I open the newspaper and I read the headlines, and it's Brexit this and Greece that and France that. Yes, it's monstrously dysfunctional. I don't think Europe's got a monopoly on dysfunctional politics at all. But are you really buying Europe? And that's one aspect of it, newspaper headlines. They don't represent what we're investing in. They're often a caricature of Europe, actually. But the other aspect is GDP, European GDP. Oh, but Europe's going into a slowdown, and Italy's in recession, and Germany's flirting with recession. Not the only parts of the world, incidentally, that are flirting with recession. Recession's a good thing. GDP, the short-term trajectory of GDP, has no relationship whatsoever with stock market returns. And the reason I say recession's a good thing is it's in recession you get bargains. You don't get bargains when everyone's saying, come on in, the water's warm, USA. Is the USA, or US equities, a bargain? No, I think they're monstrously overvalued. I'm not saying Europe's monstrously undervalued, but I'm trying to say to people, you're not even investing in Europe. If you look at the revenue, geographic mix of the revenue and profits of our businesses that we invest in, 49 of them, is it 100% Europe? Not at all. So the businesses are based in Europe, but global. If you want to buy Europe, buy European banks, or buy European utilities, or buy European telcos. That gives you Europe. The rest of it doesn't. And please don't be spooked by European GDP, Brexit this, Greece that, French banks this, that, the other. It's noise. We don't need to be there.
Okay, now you've said before that you're quite optimistic that there could be another market correction in 2019, which, if it did occur, would bring about more value-driven opportunities, particularly in Europe. So I'd like to know, is that still your position? And has anything changed in the first quarter of 2019, or any events during the period that might have affected your view on world markets?
Yeah, I mean, obviously here's the disclaimer. The disclaimer is market forecasts are a mug's game. So I'm the mug because I'm sort of commenting on short-term market direction. I do think this has been a V-shaped rally in markets that's there to be tested. That's why I have talked about you're going to get a second bite at the cherry. You know, in a sense, the cherry was Q4 2018 when babies were thrown out with bathwater. You know, many of our quality industrial names, auto-related or other industrial names, got slammed in Q4 in share price terms. Now, rightly, a shareholder at the AGM actually asked, are you not being greedy holding out for a second bite at that cherry? Maybe. But I don't think so. I think that you're going to see another sell-off in markets generally. I think this is a rally that has been V-shaped. I think we know the reasons, or the catalyst to the rally, in terms of the Fed said, whoops, we'll dial back and we will be doves again. Mario Draghi, as we speak today, is going for yet more easy loans to the European banking system. It'll do them absolutely no good whatsoever, in my view, apart from cosmetics. So the market's celebrating, or has been celebrating, reasons to rally purely from an oversold position. I think it'll be tested by a number of things. One will be earnings. Actually, I think in the real economy, industrials are slowing. I think it doesn't mean recession, but I think earnings are going to be a bit challenged for large parts of the market. The second thing that challenges me, and I think will challenge markets, is the sheer valuation of the lead market, and that's the United States. So I think you will get a sell-off again, possibly led by the US, and Europe will get caught up in that. I think 2019, if I'm right, is the moment where you're going to get a great opportunity to buy high-quality, European-based global franchises at depressed European prices. I do think you're going to get that opportunity.